You have been doing everything right. You have been disciplined. You have been frugal. You have been putting money away year after year into your retirement accounts, watching the balance grow, feeling a sense of pride and security every time you open that statement. And now, as you sit in your 60s or early 70s, you are looking at a nest egg that most people would envy. But here is the truth that nobody is telling you, and it is something you need to hear right now, today, before the end of the year catches you off guard. You are saving too much money for retirement, and that oversized balance sitting in your tax-deferred account is not a shield. It is a ticking tax bomb, and the IRS has already set the timer. The very thing you built to protect yourself could become the single greatest threat to your financial survival if you do not understand the rules that are about to be forced upon you. Let me explain what I mean, because this is not some hypothetical scenario. This is not a warning about what might happen someday. This is about rules that are already on the books, rules that are already affecting millions of Americans who did exactly what you did, who saved exactly the way you saved, and who are now watching in horror as the government reaches into their accounts and takes a bigger cut than they ever imagined possible. The problem is not that you saved. The problem is where you saved it, and what happens to that money when you cross a certain age threshold that the IRS has been quietly waiting for. Here is the first thing you need to understand. The money sitting in your traditional 401k, your traditional IRA, your 403b, your SEP IRA, every single dollar in those accounts has never been taxed. You got a tax deduction the year you put it in. The growth has been tax deferred for decades. And the key word there is deferred, not eliminated. The IRS did not forgive those taxes. They postponed them. They let you compound your money, tax-free for 30 or 40 years. And in exchange, you agreed to a deal that most people never fully understood. You agreed that starting at a specific age, you would begin pulling money out of those accounts and paying taxes on every single dollar, including the growth, at whatever your ordinary income tax rate happens to be at that moment. And that is where the danger begins. Under the Secure Act and Secure 2.0, the rules around when you must start withdrawing are very specific. If you were born between 1951 and 1959, you must begin taking required minimum distributions, also known as RMDs, at age 73. If you were born in 1960 or later, that age pushes to 75. Now, you might be thinking that sounds like a long time away, or that you have plenty of room before you hit that mark. But what you need to realize is that the clock is already running for millions of you watching this right now. And for many of you, it has already started. If you turn 73 this year, or you are turning 73 soon, you are already in the window, and the IRS is already expecting you to take your first distribution. Here is what an RMD actually is, stripped of all the jargon. The IRS looks at the total balance in your tax-deferred retirement accounts as of December 31st of the previous year. They divide that balance by a life expectancy factor based on your age, and that calculation produces a minimum dollar amount that you are legally required to withdraw from your account before December 31st of the current year. You cannot skip it. You cannot delay it. You cannot say you do not need the money. You cannot say you would rather let it keep growing. The government does not care whether you need the income or not. They want their tax money, and they have structured these rules to make sure they get it. Now, think about what happens when your account balance is large. The larger your balance, the larger your required minimum distribution. The larger your distribution, the more taxable income gets dumped onto your tax return in a single year. And the more taxable income you have, the higher your tax bracket climbs. This is the trap that nobody warned you about. You saved aggressively. You maxed out your contributions. You watched your account grow to $500,000, $700,000, $1 million or more. And now the IRS is going to force you to withdraw a massive chunk of it every single year, whether you want to or not, and tax every penny at ordinary income rates. Let me put this in perspective with a real example. Say you have $1 million in a traditional IRA, and you are 75 years old. Your life expectancy factor under the current IRS Uniform Lifetime Table is approximately 24.6. That means your required minimum distribution for the year would be roughly $40,600. That is over $40,000 of additional taxable income that you are forced to recognize, on top of any Social Security you are receiving, on top of any pension income, on top of any other earnings you might have. And if your account keeps growing, which it likely will because you are still invested, next year the RMD gets even bigger, and the year after that, it gets bigger again. It is a snowball effect that pushes more and more of your income into higher and higher tax brackets every single year. But here is where it gets even worse. And this is the part that catches most seniors completely by surprise. Your RMD does not just affect your federal income tax. It creates a domino effect that ripples through nearly every other part of your financial life. First, let us talk about your Social Security. You may not realize this, but up to 85% of your Social Security benefits can become taxable if your combined income exceeds certain thresholds. Combined income, as defined by the IRS, includes your adjusted gross income, plus any non-taxable interest, plus half of your Social Security benefits. If you are a single filer and your combined income exceeds $34,000, up to 85% of your benefits become taxable. If you are married filing jointly and your combined income exceeds $44,000, the same rule applies. Now, add a $40,000 or $50,000 RMD on top of your Social Security and any other income, and suddenly, you have blown right past those thresholds. The government is now taxing the Social Security you paid into your entire working life. And they are doing it because the RMD they forced you to take pushed your income over the line. You are being taxed on your savings, and that tax is triggering more taxes on your benefits. It is a double hit, and most retirees never see it coming. Next, let us talk about Medicare, because this is where the damage gets truly devastating. Medicare Part B and Part D premiums are not the same for everyone. They are based on your modified, adjusted gross income from 2 years prior. If your income is above a certain threshold, you are hit with what is called an income-related monthly adjustment amount, or IRMAA. This is a surcharge that gets added to your standard Medicare premium, and it can cost you hundreds, even thousands of extra dollars every single year. For 2026, if you are a single filer with a modified adjusted gross income above $106,000, or a married couple filing jointly with income above $212,000, you start paying surcharges that escalate in tiers. The higher your income, the higher the surcharge. And remember, your RMD is income. A large RMD can push you right into one of those higher IRMAA tiers. And because the look-back is 2 years, you might not even realize the damage until you are already paying the price. You could be paying hundreds of dollars more per month for the exact same Medicare coverage as your neighbor, simply because the IRS forced you to withdraw money you did not even want to take out. What this means for you is that your large retirement balance is not just a source of comfort, it is a liability. It is a number that the government uses to calculate how much they can take from you, how much they can tax your Social Security, and how much extra they can charge you for Medicare. Every dollar you have in that tax-deferred account is a dollar the IRS has a claim on, and they will collect that claim on their schedule, not yours. And if you think you can simply ignore the RMD or take less than the required amount, you need to understand the penalty, because it is severe. Under Secure 2.0, the penalty for failing to take your full required minimum distribution is 25% of the amount you were supposed to withdraw, but did not. That is not a typo. 25% of the shortfall goes straight to the IRS as an excise tax. If you were supposed to withdraw $40,000 and you withdrew nothing, you owe the IRS $10,000 in penalties alone, on top of the regular income tax you still owe on the distribution. Now, there is a small silver lining here. If you correct the mistake within a timely manner, generally, within 2 years, the penalty can be reduced to 10%. But even at 10%, you are talking about a massive financial hit that most seniors simply cannot absorb. And let me be clear, the IRS does track this. Your brokerage or custodian reports your RMD status to the government. This is not something you can hide from or slide under the radar. So, now you understand the problem. You have too much money sitting in tax-deferred accounts, and the government has built an entire system designed to extract maximum tax revenue from those accounts starting at age 73 or 75. The question is, what can you do about it? Because the good news is, you are not powerless, you are not trapped. But you do need to act, and you need to act before the trap springs shut. The first strategy you need to consider is the Roth conversion. A Roth conversion means you take money out of your traditional tax-deferred IRA or 401k, Pay the income tax on it now, at today's rates, and move it into a Roth IRA. Once that money is in the Roth, it grows tax-free forever. There are no RMDs on Roth IRAs during your lifetime. You are never forced to withdraw it. You never pay taxes on the growth, and when you pass it on to your heirs, they receive it tax-free as well. The trade-off is simple. You pay taxes now, so you do not pay taxes later, and you do so on your own terms, at a time and an amount that you control. The smart move here is to do this strategically, converting smaller amounts each year during the window between when you retire and when you hit RMD age. If you are 60, 62, 65, and you are no longer working full-time, your income may be lower than it will be once RMDs kick in. That means you are in a lower tax bracket right now, and this is the perfect time to convert portions of your traditional IRA to a Roth, paying tax at those lower rates and shrinking the future RMD that would have hit you like a freight train. Crucially, you do not have to convert everything at once. In fact, you should not. The beauty of the Roth conversion strategy is that you can do it in pieces, year by year, converting just enough to fill up your current tax bracket without spilling over into the next one. You might convert $50,000 one year, $75,000 the next, keeping your taxable income in a range that keeps you in the 22% bracket instead of letting a future RMD push you into the 24 or 32% bracket. Over 5 or 6 years, you could move a substantial portion of your savings into tax-free territory. And by the time you reach 73, your remaining traditional account balance is small enough that your RMD is manageable. Your Social Security stays largely untaxed, and your Medicare premiums stay in the standard range. The second strategy is something called a Qualified Charitable Distribution, or QCD. If you are 70 and a half or older, you can direct up to $108,000 per year from your IRA straight to a qualified charity. That distribution counts toward your RMD requirement, but it never hits your tax return as income. It is excluded from your adjusted gross income entirely. This is enormously powerful for seniors who are already charitably inclined. Instead of taking your RMD as taxable income and then donating to charity and trying to deduct it, you send the money directly from your IRA to the charity. You satisfy the RMD, you avoid the tax hit, you keep your income lower, which protects your Social Security taxation status and your Medicare premium calculations, and you support a cause you care about. It is one of the most underused tools in retirement planning. And if you are 70 and a half with a large IRA, you need to be talking to your financial advisor or your tax professional about this immediately. The third thing you need to do is look at the overall structure of your accounts. If you have money in a taxable brokerage account, money in a Roth IRA, and money in a traditional IRA or 401k, you need to think about the order in which you draw from these accounts. Most retirees default to taking from their taxable accounts first because it feels like the least painful option. But that can be a mistake, because it allows the traditional IRA to keep growing, which means the future RMD keeps getting bigger. A smarter approach, depending on your situation, is to take some from taxable accounts and some from traditional accounts in the years before RMDs begin, keeping your income in a controlled bracket and gradually reducing the traditional balance so that when RMD age arrives, the required withdrawal is small enough to be absorbed without triggering all these cascading tax problems. You also need to think about your spouse, because the rules change dramatically when one spouse passes away. If you die and leave a large traditional IRA to your spouse, they can roll it into their own name and delay RMDs based on their own age. But if you leave it to a non-spouse beneficiary, like your children, the Secure Act requires them to empty the entire account within 10 years. That means your children could be forced to take out the full balance in a single year, or spread it over 10 years, and either way, that money is taxed at their ordinary income rate, which could be their highest earning years. You could end up pushing your own children into a higher tax bracket with the inheritance you left them. A Roth IRA, on the other hand, still has the 10-year rule for non-spouse beneficiaries, but every dollar they withdraw is tax-free. The difference between leaving your children a traditional IRA versus a Roth IRA could be tens or even hundreds of thousands of dollars in taxes that they never have to pay. Now, I want to be very clear about something. I am not telling you to stop saving. I am not telling you that retirement accounts are bad or that you made a mistake by contributing to your 401k all those years. What I am telling you is that the rules of the game change when you cross certain age thresholds. And the strategy that got you to this point, accumulating and deferring, is not the same strategy that will protect you going forward. Accumulation and distribution are two completely different phases of retirement, and they require two completely different approaches. If you keep treating your retirement accounts the same way you did when you were 45, you are going to pay for it, and so will your family. You also need to be aware that tax rates are not guaranteed to stay where they are today. The Tax Cuts and Jobs Act of 2017 is set to expire, and when it does, many of the current tax brackets will revert to higher levels. If you are sitting on a large traditional IRA balance and you are waiting to take distributions because you think today's tax rates are as low as they will be, you might be making a very expensive bet. If rates go up in the coming years, every dollar you are forced to withdraw through RMDs will be taxed at those higher rates, and your tax bill will be even larger than the calculations I walked you through earlier. This is why, acting now, during this window before RMDs begin and before potential tax rate changes take effect, is so critical. Let me also address those of you who are still working in your late 60s or early 70s. You might think that because you are still earning income, you do not need to worry about RMDs or withdrawals. But here is the catch. If you are still working and you own more than 5% of the company that sponsors your 401k plan, you are still subject to RMDs on that 401k regardless of whether you are still employed. And even if you do not own 5%, while you may be able to delay RMDs on your current employer, is 401k until you retire. Any old 401k plans from previous employers and any traditional IRAs you have are still subject to RMDs at age 73. There is no free pass just because you are still working. The IRS wants their money, and they have structured the rules to make sure they get it from every account that qualifies. So, let me bring all of this together, because the bottom line is this. You spent your career building a retirement nest egg, and that discipline and that sacrifice deserve to be rewarded, not punished. But the current tax system does not reward large balances in tax-deferred accounts once you reach RMD age. It penalizes them. It forces you to withdraw money you may not need, taxes that money at ordinary income rates, uses that forced withdrawal to tax your Social Security, and uses it again to inflate your Medicare premiums. And if you miss the withdrawal, it hits you with a penalty that can reach 25% of the shortfall. This is not a system designed to help you keep your money. This is a system designed to collect, and the larger your balance, the more aggressively it collects. What you need to do right now, today, before the end of this year, is sit down with a qualified financial advisor or tax professional who understands retirement distribution planning. Not just someone who helps you pick investments, but someone who understands the intersection of RMDs, tax brackets, Social Security taxation, IRMAA, and Roth conversions. Ask them to look at your current account balances and project what your RMDs will look like at age 73, 75, and beyond. Ask them to model different Roth conversion scenarios so you can see exactly how much tax you could save by converting strategically over the next several years. Ask them whether a qualified charitable distribution makes sense for your situation. Ask them what happens to your spouse and your children if you pass away with these account balances as they currently stand. Get the numbers in front of you, because when you see the actual dollar amounts, when you see the difference between doing nothing and taking action, it will change everything about how you think about your retirement savings. This is not something to put off until next year or until you get closer to 73. The window for action is open right now, but it is not open forever. Every year you wait, your traditional account balance grows, your future RMD grows, and your options narrow. The best time to start was 5 years ago. The second best time is today. Your money should work for you, not for the IRS. Your savings should protect your family, not fund a tax bill you never planned for. Take control of this situation now, because no one else is going to do it for you. I am Norix Kale, and this is the Federal Benefit Guide. My job is to make sure you understand the rules that govern your retirement, your benefits, and your hard-earned money, because the government is counting on you not knowing. They are counting on you being too busy, too overwhelmed, or too trusting to look closely at how these rules affect you personally. But you are here, you are listening, and that means you are already ahead of most people. If this information helped you, if it made you think differently about your retirement accounts, then make sure you stay with this channel. because we are going to keep breaking down the policies, the rules, and the strategies that protect seniors like you from losing money you worked a lifetime to earn. Share this with anyone you know who is approaching retirement or already there, because the people who need this information the most are often the ones who never hear it until it is too late. Your retirement should be your reward, not the government's payday. Stay informed, stay protected, and take action before the rules take action on you.